If you're thinking about buying your next home before selling your current one, well, there's one question you need to ask first. What happens if your current house doesn't sell? This is where a lot of homeowners typically end up getting stuck. I mean, they want to move, they're ready to move, but how? How do they do that? If you don't have a plan to be able to execute that move, this can get really expensive really fast. I mean, you could end up with 2 house payments. You could end up with price drops that you didn't plan on, or worse, you could end up selling your house, but in a complete panic because you're out of time. You have to hurry up and get your house into escrow. The good news though, you don't have to do that. In this video, I'm gonna walk you through 6 ways that homeowners right now are doing just that. They're buying their new home and then selling their current house without falling into those traps I just mentioned. Obviously, if you're watching this video, I'm assuming that's exactly what you're wanting to do. Buying and selling without getting stuck. As I mentioned already, here are 6 ways that you can do that to be able to buy your new home and then sell your current one without losing money, without getting stuck, and without becoming a desperate seller. Sorry, before we do get to that, if this is your first time here, my name's Jose and I am your SoCal Realtor. Here we help Inland Empire homeowners sell smart, buy their next home better, and move with confidence. So if that is you, if you are thinking about making a move, don't hesitate to reach out. My contact information is below. We help people just like you every single day. But enough about that. Let's go ahead and get back to the video. First, you have the contingent sale or contingent purchase, and this one just might be the most commonly used option on this list, actually. This is when you sell your house or make an offer to purchase a new home contingent on something else happening. Meaning this. You put your house up for sale contingent on finding your new replacement home, or you make an offer to purchase a new home that's contingent on being able to get your current house sold. The idea behind the contingency is to protect you. So for instance, if you put your house up for sale contingent on being able to find a new home, but you can't find the right one, then you don't move forward with the sale. Nothing happens. Like I said, this is a very common or very, very popular strategy used by many homeowners. They're looking to do that, be able to buy their new home and then get their house sold. But being completely transparent with you about it, there are a couple things that you do want to consider when it comes to contingencies, such as this. Let's say, for instance, you do go out, you make an offer to purchase a home contingent on being able to get your house sold, or vice versa. You put your house up for sale contingent on being able to find a new home. But if you make an offer that's contingent on being able to get your house sold, well, depending on the current housing market, I mean, you could have a tougher time with that contingent offer that you just made. Not always, but you could. Because if we look at that scenario where you made an offer that's contingent on your house selling, well, depending on the market, let's say it's a strong seller's market. They're getting a lot of people in there looking at their house, and they get 2 offers for their house. One from you, the contingent offer that you made, one offer from you, and then one other offer. And this, for example, let's just say that they're both the exact same price. So there's no difference there. The only difference is one thing. Your offer has the contingency. The other one doesn't. Which one do you think they might be more inclined to accept? Not saying that this is a bad option, trying to talk you out of it. Again, like I said, this is probably the most popular option on this list. It's just that all of them, all 6, have their pros and their cons. So I just want to make sure you are aware of them. Number 2 is you sell your house, but you do a lease back on your house after the sale. Yeah, you might be looking at me now wondering, okay, Jose, what in the world does that mean? But let me explain. With this one, you're putting your house on the market, you're putting it up for sale, but you're putting a temporary pause when it comes to going out looking for your new home. For the moment, that is. Now, once you do get an offer for your house, and you want to make sure that you have all this negotiated, everyone's agreed to it before you accept anything, but once you've done that and you close and finalize escrow on the sale of your house, you then temporarily rent the house back from the buyers, the new owners of the house. Typically, the rent time can be anywhere from a couple of weeks. Although if you're planning to use this time to find your new home, you may want a little more time than that. To as much as 30 days, maybe even 60 days. I get it. For some, they might hear this and think, I don't know about that. I don't know about becoming a tenant in what was once my house. But for others, this can be a really good option to be able to to help relieve some of the stress that could come with being able to do this, being able to buy a new home, selling, time everything up. But listen, just like with the contingencies, when it comes to rentbacks, there are a couple things to consider here also. First of all, the clock is ticking, meaning you only have as much time as everyone agreed to, whether that's 30 days, 40 days, 60 days, whatever it was, but you only have as much time as everyone agreed to. So you definitely don't want to be all lackadaisical about going out and finding a new home. I don't know about today. We'll go look tomorrow. I mean, you only have so much time. Secondly, this one isn't free. Yeah, using a contingency, that one doesn't cost you anything extra, but doing a rent back, well, that one is you're renting the house back for an agreed to time, for an agreed to amount also, but for an agreed amount time from the new owners, the buyers of your house. Number 3 is using what's called a bridge loan. This is a loan that's designed for this exact type of thing, a bridge loan. It's a short-term loan. It's designed to essentially bridge the gap between selling your current house and buying your new home. Here's how they work. Again, they're short-term loans, usually going to be about like a 6-month loan. You might find some that'll give you as long as 12 months on it, but usually going to be more in the range of like 6 months. But they allow you to use the equity from your current house to help you make the purchase of your new home, which can give you some serious flexibility. You find the new home that you love, you make an offer and purchase your new home without a contingency. I mean, the seller doesn't even know you still have a house to sell. However, there is a cost to a bridge loan because, I mean, it is still a loan. I mean, short-term loan, bridge loan, doesn't matter. It is still a loan. So you are going to have typical loan costs, closing costs, things like that. The payment for that loan, that one can vary from one lender to the next. So definitely that's a great question. Make sure you talk to your lender about it. But you'll probably find many that say, hey, you know what, we just require interest-only payments on the bridge loan until your house sells, and then just pay it off. You might find some that don't even require a payment until, again, your house sells, and then, again, you pay it off. Just the point, though, is this. The bridge loan, it certainly can help to make things a little more convenient. Just keep in mind, there is a cost to that convenience, though. Another option, another loan option, is the HELOC, or home equity line of credit. A HELOC is technically a loan, but it works a lot more similar to like a credit card, meaning this, you get approved for a certain credit limit based on the equity that you have in your house, and then you use whatever amount of that credit limit that you want to use. You don't have to necessarily use it all, but you use whatever amount it is that you want to use or need to use during the draw period or accessibility period, which is usually going to be about 10 years. Here's what I want you to really think about, though, before going this route. Until your current house sells and you can pay everything off, you are going to be looking at extra money going out every month. I'm not saying that a HELOC is necessarily bad. No, because it can definitely be a very helpful option when it comes to helping you purchase your new home. I mean, quite a few people have used this as a very legitimate and viable option for that. I just want to make sure that you're aware that you're keeping in mind that when you do use a HELOC, you could be looking at 2, maybe even 3 monthly loan payments. The payment for the HELOC, the payment for the new mortgage on the home that you just bought, and if your current house still has a mortgage balance, then yeah, that one too. At least until your current house sells, and then of course, use the proceeds, pay everything off. But just like with the bridge loan, getting a HELOC, it is still a loan, so keep in mind there are loan costs involved here also. Quick pause here, because if you're listening to this and you might be starting to think, oh man, there's more involved to this than I was thinking. Don't worry, got you covered. I put together a free guide. It covers the top 7 most costly mistakes when buying and selling at the same time. Breaks down exactly where people tend to typically get stuck, but it also covers how you can avoid that. So you can download it after the video, but you'll find the link for that down below. Another option is to borrow from your savings or your retirement account, your 401k. Now, if you have money that's available and sitting there in your savings account, I mean, this one's pretty straightforward. You already have the money, use it, done. But borrowing money from a retirement account, a 401k account, yeah, that one's a little more involved. I mean, first of all, there's limits as to how much you can actually borrow or access. Also, whatever it is that you borrow from the retirement account, you do have to make monthly payments back on that. Here's the part about that can catch people off guard. If you leave your job for any reason, well, the outstanding balance of what it is that you borrowed, that could immediately become taxable. And if that happens, depending on your age, you could end up becoming eligible for an early withdrawal penalty on top of that. I'll just say that if there's any chance of maybe you leaving your job or maybe a layoff or anything like that, just be sure that you talk to a financial advisor before going this route. I mean, it can absolutely work. I've seen it work, but it's not one to take lightly. Then there's the option to pull equity from your house and turn it into a rental. I find this one oftentimes getting mixed reviews, and I get, I mean, not everyone wants to become a landlord. There's extra responsibilities and requirements on you when it comes to becoming a landlord. But if you do, if you pull the equity from your house, help you to make the purchase of your new home, hold on to this as a rental, I mean, you're not just solving a short-term problem. You're potentially building long-term wealth at the same time. That said, though, you do need to have a real and solid plan before you do go down this route. Because listen, a rental, yeah, that's not something you want to just wing it. No, I would say ask yourself these questions first. Number one, do you have a plan in place for repairs and vacancies? Because if you have a rental long enough, you will experience both at some point. And number two, does the rent that you collect cover your mortgage, your insurance, taxes, maintenance? In other words, does the rent that you collect actually cover your costs for owning the rental? If the numbers line up though, I mean, this could be a very strong long-term play. With all those options though, at this point you might be starting to wonder, okay, so which one's the best move? It depends. I mean, there really is no one right answer. It's more about finding the right answer that fits your situation, your income, your equity, your risk tolerance, and your timeline. Because taking the wrong approach here, that's what leads to stress. That's what leads to rush decisions and ultimately leads to losing money on the sale of your house. But the right approach though, that's what's going to give you peace of mind over your move. So if that is you, if you are serious about making a move, don't hesitate to reach out. My contact information, that is below. Also, don't forget the free guide that I mentioned earlier, top 7 mistakes to avoid when buying and selling at the same time. You'll find the link for that down below also. But now that you know which options provide you more flexibility with making a move like that and which ones could seriously backfire if things don't line up, the last thing you want to do though is go into all this without understanding how all the numbers work when selling your house. In fact, a question I do get quite a bit is, well, what exactly happens? How does that work if I'm trying to sell my house and I still have a mortgage balance on it? And unfortunately, I do find that there are many people that believe that it's not possible. You can't sell your house if you still have a mortgage balance on it, and that's not necessarily always true. In fact, let me do this. I'm going to break that down for you. Let me break down how that works, how all the numbers play out and work with that. In fact, I'll do that right here in this video. So let me break that all down for you, walk you through all that. Be sure to catch this video next, and I'll meet you over there.